Did you know that one of the key elements of the smart money concept is imbalance, also known as fair value gap? These are areas on the chart that the market tends to fill, and this is where the best entry points for the big players appear. Today we're going to understand what imbalance is, how to find it, and most importantly, how to use it in trading. And at the end of the video, I will show you a proper strategy based on imbalances, which will help you to find accurate market entries with minimal risks. Before we get into the strategy, let's break down what imbalance is and why it plays a key role in smart money concept. Imbalance or fair value gap is an imbalance between buyers and sellers that occurs when there is a strong impulsive price movement. It is a moment when the market lacks liquidity and the price literally jumps a level without significant counter volume. On the chart, such an imbalance looks like a candlestick gap between the closing price of one candlestick and the opening price of the next one. Visually, it appears as a large candle with minimal shadows, where the price moved in one direction without serious pullbacks. The most important thing when working with imbalances is to realize that the market tends to close such zones. This means that the price sooner or later returns to the imbalance area to restore the balance between supply and demand. Why does this happen? These zones hide unexecuted orders of large players who did not have time to accumulate or unload the position during the impulse movement. This is why market makers and institutional traders bring the price back into this range to complete their trades. In summary, imbalances are not just gaps on the chart, but key zones that give us insight into the intentions of the big players. And if you learn to analyze them correctly, you can find accurate entry points with a high probability of working out. To use imbalances in trading, we must first learn to find them correctly on the chart. The first thing we do is to find an impulse price movement. This is a sharp rise or fall accompanied by large candlesticks with minimal pullbacks. Such movements indicate an imbalance between supply and demand and create areas where market makers may have left unexecuted orders. Next, we highlight the imbalance zone. Imbalance is formed on 3 candlesticks in a row. The first candlestick sets the impulse movement. The second candlestick continues the movement and creates a gap between its low in a bullish movement or high in a bearish movement and the first candlestick. The third candlestick does not bridge this gap, leaving an empty space on the chart between the high of the first candlestick and the low of the third candlestick, or vice versa if the movement is down. Visually, it looks like a void in the price structure that the market tends to close. The third step is to identify key zones of price return. It is important to realize that the price does not always fill the imbalance completely. In most cases, the return occurs at least 50% of the FVG zone, after which the movement continues in the initial direction. The most important thing in searching for imbalances is to take into account several points. FVG size. The bigger the gap is, the higher is the probability of price return to this area. Market context. Imbalances are effective if they are formed near liquidity levels, order blocks, or supply and demand zones. General trend. Imbalances more often work in the direction of the main trend, so it is important to take into account the market structure. Now that we know how to find imbalances, let's look at a specific strategy for entering a trade based on price, returning to the imbalance zone. Identify the trend and market structure. Before using imbalance as an entry point, it is important to understand where the market is moving in general. In a bullish trend, we look for imbalances to buy. In a bearish trend, we use FVG to sell. If the market is flat, it is better to wait for a range exit. Here it is very important to consider time frames. Imbalances on the higher time frames, H4, D1, W1, have a stronger influence on the market than on the lower ones. For example, if a bearish imbalance is forming on M15, but on H4 we are in the bullish FVG zone, we should focus on the higher time frame. In this case, the price is more likely to close the local bearish FVG, but then it will reverse and continue moving upwards along the global trend. After a sharp upward or downward price movement, an imbalance zone remains on the chart. We highlight it and wait for the price to return to this area. The touching of the imbalance zone does not mean that the price will immediately turn around or continue the movement. It is just a zone of interest for big players, and before they take a position, the market is often manipulated. The main confirmation before entering is liquidity withdrawal. What does this mean? Imagine that the market is moving towards the FVG area. Many traders, seeing this area, place pending orders or stop losses near the obvious levels. The big players know this and often knock out the stops of retail traders before sending the price in their direction. This happens through a breakout of a local high or low liquidity gathering behind support and resistance levels, or false momentum. Now that the extra players have been knocked out, the market can move on, and this is where entry points come in. There are two options for entering a trade after liquidity withdrawal and retesting the imbalance zone. The first one is an aggressive entry. Here we do not wait for additional confirmations, but open a trade at 50% overlap of the imbalance zone. This approach works if the market is already moving in a given direction, and the price just comes back to pick up liquidity. In this case, stop loss is placed beyond the imbalance boundary, and take profit at the nearest liquidity zone. The second approach is a conservative entry. Here we wait for the price to react to the imbalance zone. We enter the trade only after confirmation, not in advance. The choice of method depends on your trading style. If speed and dynamics are important to you, an aggressive entry allows you not to miss a move. If you prefer additional reliability, a conservative approach gives you more confidence in the trade. But no matter which entry method you use, it is important to realize that even the most accurate imbalance zones are not always worked out. Let's look at the main mistakes that can lead to losses in trading with imbalances. Even if you have learned how to find and trade imbalances correctly, there are mistakes that can lead to a deposit drain. Let's analyze the most common ones. The first mistake is ignoring higher timeframes. Traders often see FVG on the lower timeframe and immediately enter the trade. But if the trend is directed in the opposite direction on H4 or D1, the probability of successful execution of the zone drops sharply. Always analyze the context. Imbalances on the higher timeframes have priority over the lower ones. The second mistake is an incorrect stop loss. An incorrectly placed stop is one of the main causes of losses. If the stop is too close, the price may catch it before going in the right direction. If it is too far away, the risk-reward ratio becomes unfavorable. The perfect stop loss should be outside the FVG or order block boundary, which confirms a reversal. The third mistake is not having a clear plan. Many traders enter a trade without knowing where they will exit. They either hold the position too long, losing profit, or exit too early, fearing pullbacks. To avoid this, determine take profit in advance. It can be the nearest liquidity zone, support, or resistance level. The fourth mistake is trading from imbalances without confirmation. If you open a chart in TradingView, you can see many imbalance zones. Some of them will be bullish, others will be immediately bearish. This creates a false sense that each FVG is an entry point. However, if you enter the market on every imbalance you find, you can quickly drain your deposit. Not all imbalances are equally important. Big players use them to gain positions, but not every imbalance leads to a strong move. How to distinguish between working imbalances and weak imbalances? It is important to consider the trend. If the market is in an uptrend on H4 or D1, but a bearish FVG appears on M15, it may be just a minor correction, not a reversal point. Additional confirmations are the basis for a correct entry. As mentioned earlier, touching the FVG is not enough. You need to wait for the price reaction, structure change, or liquidity withdrawal. Therefore, you should not trade from every imbalance. The main thing is to filter them by strength, confirmations, and market context. Imbalance trading is a powerful tool, but it requires detailed market research, constant analysis, and practice. If you are not ready to spend time searching for entry points and understanding complex market mechanics, but still want to trade and earn, we have an alternative solution. MiloBot PRO Expert Advisor is a fully automatic trading system that trades without your participation. This expert advisor does not use imbalance strategy, but allows you to make stable money in the market, thanks to its built-in algorithmic trading strategy. Over the last 4 years, MiloBot PRO has increased its deposit from $34,000 to $272,000, and you can check the results yourself on the Independent Monitoring MyFX book. If you want to test it risk-free, download the demo version and check its performance on historical data. You can purchase MiloBot PRO or download the demo version on the MQL5 website. All links are in the description below this video. Today we have analyzed in detail what imbalances are, why they occur, and how to use them in trading. Now you understand that the market tends to fill imbalance zones, and big players use them to gain positions. But you should not rush into trading right away. Test your strategy first. Conduct backtests, study how imbalances work on different timeframes, and try practicing on a demo account. And in the next video, we'll look at another important tool in smart money concept, order blocks. This is one of the key elements that institutional traders use, and if you want to go deeper into smart money logic, this video will be useful for you. Give a like to this video, subscribe to the channel, and turn on notifications to make sure you don't miss new videos.